All right, Vic, how are you?
I'm doing good, man. How are you?
This happens with age. Don't worry. It'll
I,
happen to
I was gonna leave. I was gonna leave it alone.
you. um, no, no, no. It's all good. It's all good. Um, I was thinking,
hmm
I don't, I don't see, I can't imagine that any kind of an historic event like the stuff that went on this weekend, like whether it's whatever it is, doesn't we don't have to get into details of, you know, of we don't have to get into details, but when you have an event like that, do you think it impacts volatility going forward or markets or anything like that? I mean, is there I don't think it does. I don't think the markets will react one bit, but I mean it's not 9/11 type thing. But economic or because somebody just wrote me an email. They said, "Is there anything economic or market wise that that kind of comes from this type of thing?"
my quick answer. I'm curious to know what your thoughts are. My quick answer would be no. I think the market has started to price in Donald Trump's probabilities increasing as of last week. Predicted, I think it was like 62%. I don't know what the numbers are as of right now, but I find myself thinking of Chris Cole's quote because in a way, I feel like there's a societal volatility are at probably multi-decade highs. We haven't seen this level of societal volatility within American society in, I don't know, 50, 60 years. But asset volatility are at or near historical lows. And so Chris Cole has this quote that volatility cannot be destroyed. It can only be transmuted. So, I just have this thought that in our quest to minimize or neutralize asset volatility, I wonder what the impacts on society have been. I don't know if that was too deep of an answer than what you were looking for, Tom, but
Yeah, I
what are
was
your
looking
thoughts?
for that answer you could have given to me anytime volatility is low. Like I
Mm.
agree with that. You can, you know, fear is not something that can be fear is not something that can ever be contained. Fear is just something that really weird opening too. They sold them off about 20 handles on the close. They just opened them up about 15, then they sold them off. Next tick was down 10. I mean 10 lower. Really, really strange opening tonight. Bonds also down 24 and notes down 10 ticks. It's a pretty big opening. Also, Bitcoin up 3,600 tonight. I
hmm
mean, maybe all of a sudden it didn't impact anything else other than digital assets. I don't know. That's kind of what I was, maybe alluding to a little bit. Is there, what marketplace, um, what marketplace might be impacted by this kind of an event? Or I doubt any, but it looks like digital assets more than anything
Yeah.
else.
Silver down 0.5%, gold down just a little bit. So it's the inverse of what we saw last week. Last week we saw metals advance and digital assets kind of a little bit heavy, and it seems like at least for now we're seeing a little bit of a reversal in that.
Yeah. Well, I never bought into any of that Mount Gox crap. I didn't, I don't, I never, that's just garbage to me. But, uh, I think that, um, yeah, I mean, it's funny. I started my career, um, in the early 80s, and I think Reagan was shot in 1981, I want to say. I don't remember, but I think it was 1981. And we didn't really have televisions back. You remember there really weren't flat screens. I know I'm dating myself, but I had started a couple months earlier, like 6 months earlier. Whenever Reagan was shot, I was like 6 or 8 months into my first job, my first real job ever at Drexel Burnham, and I was in front of a Quotron on a trading desk, and I remember the news coming across Dow Jones on the Quotron, and it was Reagan was shot, and then somebody had to you had to find a TV. like TVs weren't readily, weren't out there, and there was no indexes at the time, so there was no way to know like kind of what to trade. But the uncertainty of um, the president being shot because he was a president at that point, and not knowing what happened. Like you didn't know if he was dead or whatever. That uncertainty caused a lot, like a really strong sell off in a lot of the big names, but there were no indexes, so it was not a tradable event. But it's just interesting that it's been, essentially we've come however long that's been, almost, 43 years or something like that, and to another similar event where now markets are open all the time, and you just disseminate the news, and it's just like, okay, you know, time to make the donuts type thing.
Do you think this is the crescendo, and we start to
No.
cool down as a nation from here?
Oh, I think the good part about this is that this is going to be, in a crazy way, Trump is incredibly divisive. I mean, more divisive than any person I've ever seen in history. And this normalizes the whole thing. I think it brings everybody back to, you're right. It does take away some of the divisiveness, and it does change. I think it's going to change his perspective on things. I think it's going to change the relationship between him and Biden, and just like, it's going to become more civil, because these guys realize at some point, you know what? It's just a stupid game, right? It's not, I mean, as much as you want to think, it's not personal. Like, it can't be, and they made it too personal. And I think it's we've got to be realistic about that. There's bigger problems, and there's nutcases out there, and there's things we have to deal with, and you got to be careful about, things that you say, because those things can come back to haunt you. And so I think it will change things.
I hope so. I definitely hope so. Let me ask you. Obviously, the story from last week was the massive rotation. We saw a Six Sigma move in the Russell versus the S&P 500. I think. Yeah. I'm curious. I've got a slide to throw up here. I don't know if Paul can put it up on the screen, but I'm curious from your perspective. For the first time in, I think, most of the year, there was a massive run to small caps, massive run to value over large cap growth for the first time. I mean, do you think that continues here?
It was one day. I mean, it started off this.
Friday is a little bit of follow through. It was a little follow through.
Friday started off with follow through. I have that position on, so I'm very clear. And Friday was actually a loser. If you were long Russell, short Nasdaq, on the very close, it normalized a little bit and was like kind of a wash to a small winner. But the whole day it was a loser. A one day outlier move does not change anything in my book. I think
even if it's a Six Sigma move.
I don't know if it was a Six Sigma move. I don't think it was. I think it was less than that, but it could be. I don't think it was, but I think it could be. I guess my point is that I don't think one day counts. I want to see some follow through. I think the whole second half of the year, you're going to see a strong Russell relative to everything else. I think you're going to see a very strong Russell. And, look, tonight's weird because we opened up really pretty high. We sold. Remember, we had a huge sell-off on the close. I know it's not going to. People aren't going to know because we still closed up big on the day, but we were up like, 65 points, 65 handles in the S&Ps at one point, and we closed up 28. So we lost in the last half hour, 30 handles of upside. And the bonds right now, just tonight on a Sunday night, are right back to where they were.
They're giving it up.
They gave up that entire move from the CPI move on Thursday. It wouldn't surprise me if the S&Ps gave up the entire move as well. Like, everything. It just wouldn't surprise me. But bonds have become far more cyclical than stocks, and most commodities have become a little more cyclical than stocks. I think it's going to be a fascinating week because it's July expiration. July expiration tends to be in the last handful of years, I think 4 or 5 years, really bullish. And the markets, the market's in that danger zone. It's sitting on thin ice. I think it's 30 points, 30 handles away from all-time highs. And if you lose the bonds here, I don't see how the market stays up. If there's a lot of things, there's a lot of reasons to sell. Let's put it that way. I think there's fewer reasons to buy.
Earnings season kicked off last week. Most of everything was in the expected move. I think maybe like Bank of New York and Wells Fargo was probably outside of its expected move. This week, more banks: Goldman Sachs, BlackRock, Bank of America, Morgan Stanley, and Charles Schwab at the beginning of the week, and then Netflix, Taiwan Semiconductor, a few pretty big names towards the middle end of the week. How are you thinking about just playing binary events in general? Are you thinking about this earnings season differently than the last one?
Yes, 100%. I
What do
am
you mean by
completely on
that?
the sidelines. And it's very rare for me to be on the sidelines of earnings events, but I am completely on the sidelines unless I find something where the IVR is up around 100 or something, and I really feel like there's interesting potential. I think with implied volatility as low as it is right now, the VIX futures are in the 12 handle, the VIX cash is in the low 12s. I find that the risk reward on earnings trades right now, I do not like it at all. If you find a situation where there's an unusually high implied volatility, then I think it's okay to trade the earnings. But with this low volatility, I mean, so far the expected move of the first couple of financial stocks was less than 3%. You can't trade earnings on a 3% move, whether the stock's a $200 stock or a $50 stock. I mean, a $50 stock, you're talking about a buck 50. On a $200 stock, you're talking about $6. You know, there's nothing in that expected move premium to make that worthwhile.
Mm.
So I am not loving earnings trades right now, but that can change this week if you get a little bit of a down move in the market and you get some, stocks like Netflix, which is the first like kind of real player that has, big outsized moves, that there may be something there.
So your point is if you get overall market volatility, then you'd be more willing to play individual binary events.
Yeah. Yeah. I think that the starting point, you're starting so low right now that if you have a 12 VIX and you're looking at a 3% expected move, there's no room for error there. I understand, yeah, it worked for JP Morgan, but it didn't work for Delta Airlines. It's hard to say. Like it's been pretty much, but there's not a lot of, it's not worth the risk. Like for JP Morgan, there was $2 in, you're basically unlimited risk for, 50 cents, a buck. I don't know. It's not, I don't like it. I don't know. I mean, if you're going to take unlimited risk, then light it up in Netflix, and give yourself a chance to make 8 or 10 bucks. I don't like it in in stocks where it just I don't like the risk reward. So I've been quiet so far for earnings. I haven't done anything yet.
Does any part of you care what the size of the company is? In other words, would you ever say I'm more willing to play large cap companies, less willing to play smaller mid cap companies in terms
Sure,
of
of
binary
course.
events, or do you not look at it that way?
Well, you look at the liquidity. So I'm less likely to play less liquid stocks. I'm more likely to play more liquid to play stocks that have more liquidity. I mean, the bigger stocks have more liquidity. Stocks like when you're talking about there's five $2 trillion plus companies. Amazon, Google, Microsoft, Apple, and Nvidia. Each one of those companies is bigger than most indexes or most countries ETFs all around the world. You're talking about so those to me are like they're like indexes, and I think I'm totally comfortable with playing into stocks. I mean, listen, a stock like Nvidia can go down $100, but a stock like Nvidia can't be taken over. There's certain risks that don't exist in Nvidia, Apple, Microsoft that may exist in other stocks, and so yeah, I'm more inclined to play bigger stocks that are more liquid. Absolutely.
I ask because I wonder if this earnings season, if we're going to see a catch up in small and mid cap stocks, I wonder if this earnings season, the small and mid cap binary events, we're more likely to see catch up. So maybe 2-3 earnings seasons ago, we see, Facebook, Nvidia, all these runaway
sure.
large cap stocks. I wonder if this is the earnings season, if we're going to see a catch up, that the binary events are an opportunity for small and mid cap stocks to have these large adjustments, which help catch up with large cap growth.
I mean, there's fewer people follow them, so there's better chances of them, surprising upside or downside. Plus, that's how they put themselves on the board. They purposely create surprises. So I think but the volatility will reflect. The volatility does a pretty good job of reflecting that kind of risk. You just got to find liquidity. If there's liquidity in small cap stocks, great. I mean, Russell has decent liquidity compared to the other indices. If you want to trade an indice right now, IWM, RTY, they're pretty good relative.
All right, man. What do you say we get Pete on here?
Let's do it.
Pete.
Gentlemen, wild week we ended up with, and some sobering news over the weekend. But it's amazing that we look at, if you look at where everything was, equities, bonds, gold, what Friday we were basically unchanged from those beginning Wednesday levels. But in the meantime, we had incredible down moves and up moves that were really interesting tradable opportunities. But Victor, it's interesting. I kind of agree with you in terms of, Russell had a tremendous move to the upside and NASDAQ got pummeled. And Friday, we saw NASDAQ recoup almost 70% of that down move. Spooz recovered all of it to, I think, print new all-time highs. Russell still ended up on the day. So it was the one time where we saw the market could go up and down and Russell held in. And maybe I'm building too much into just 2 days moves. But I do think when you go out and look at some of the bottom feeding that's going on right now and stuff, and I honestly, I think there is a connection between, we've seen the 210 yield, which I like to track, moved over almost 11 basis points last week. We're into 26 basis points, which is the cheapest it's been since it went inverted up to 100 basis points of inversion. They've got one rate cut priced in right now in September, and they're notching into November and December pretty quickly, additional rate cuts. So that could change depending on the next inflation number and everything. So that's only so much, but I think it's really interesting to see that if this yield curve reversion really does snap out and we get back to zero quickly and start to normalize, I think that's going to be the biggest plus we could see for Russell continuing to exhibit outside strength through the rest of the year.
You've been talking about that 210 spread, and you just mentioned it came in big last week as people started to price in the likelihood of a cut in September. Went from like 60-something% up to, I think, mid-80s, 85, 89% last week.
Yeah.
So you got it's a pretty big move, 11 basis points in the 210 spread in just a day or two. What do you think? Do you think as we move closer to September, do you think that moves over, that trade's over for a while, or would you continue? Do you like that as we get into the cutting cycle and the potential for a normalized yield curve? Do you like that trade into the back end of this year?
I do, because I think it tends to, when it does get back to that inflection point, it will move quickly as it gets. When we dabbled before we went inverted, we went close to it, bounced up to 20, 30 basis points, closer down and sat there. But once we went through, we went inverted very quickly and very steeply up to, I think the high was an inversion of 48 basis points before we put the next leg in. I think we're in the same situation here. This is a trade I'd like to hold a little bit longer. I think we can actually see if and we've talked about it, if they had way too many cuts priced in the beginning of the year, I think they probably are slightly under betting on what the cuts are going to be. And I'm just kind of playing it from a pot odds standpoint. I think we can probably see, even if we get back to zero on that curve trade, that's a pretty big move. And I think we have the legs to do that here. So yeah, I like holding on to that one for a little bit now. I've built a decent position. And I think I'm going to sit with this a little bit because even today with yields bullish or bearish, bonds up or down, that consistently, even today, it's performing again with bonds down on a little bit of the geopolitical news from over the weekend. Dollar a little bit stronger. Yen had a great outsized move. It was a great turnaround in the end, but it cost the Ministry of Finance $3.5 trillion to get it there, which troubles me that it only rallied 150 points. But
you know what? There's a lot of people that have been bottom picking in there. I was thinking about this, Pete. There's a ton of people that have been bottom picking, and they're thinking the same thing that you just said. Hey, it only moved at whatever, 1,000, 1,500 basis points, and so what they're thinking is I'm just puking it. I think this is one of those moves where this is the tip of the iceberg in there. I really do. I think this is like just, they're. You're right. It's not going to happen overnight, but I think this is where the weak hands are getting out.
Well, that's the question is if it stays up.
Hands.
If it stays up here, then they're challenging these long-term dollar longs. All the guys who are in the carry trade. Is it much of a challenge right now? Yeah, it's an inconvenience. But if it holds and they can build on it, yeah. But last time we saw the intervention like this, we saw a bigger move, and over the next 6 weeks, they put in new all-time lows at the end. So it'll be interesting.
Yeah, no, I understand.
Yeah.
I think I understand. I think it's just. I think this time it's. Weak hands getting out. They played for a bigger move than this. It didn't happen. They got their little bounce. They got back to even. They just banged it out. I don't blame people, unless you have a very long-term view, and again, it's a crappy trade.
Right. Yeah.
It's a crappy trade. It's, what does it have? 8% vol in there now? who cares?
Yeah.
Well, Vic, I just put my money where my mouth is and sold some 116 puts in August in the bonds because I covered my longs last week, so I might as well get a little bit long again. I think you got to trade bonds from the long side. If they trade into, I'm going to buy them in the 118 handle, the 117 handle, and the 116 handle if they get down there. I just think they're a trade from the long side. We'll see.
And I think, Tom, honestly, if we're down a full point on the news over the weekend, which is troubling, but
I don't know why that would push the bonds lower. I mean, why would what's the thought process there?
I think the thing is, dollar's a little bit stronger. It's like, is there uncertainty in holding U.S. assets? I think that's a convoluted thought and a reflexive process.
If that was the case. If that was the case, the S&Ps would be up more. I don't think that. Or down more. I don't think that's the case. I think if you want to make a geopolitical case, the thought process around the street is that if Trump's odds to win went up at all because of the shooting over the weekend, then the street perceives him winning as being very bearish for bonds. That's it. I mean, that's the only thing you can tie. I mean, there's this inverse relationship between yields. They think his policies are going to be inflationary. Hence, bonds are going to go lower. Yields are going to go higher. That's the only thing. But that, again, it's so early. It's a ridiculous. If you're trading bonds based on election results, you're crazy.
You're early. Yeah, absolutely.
You're going to have 10 more. You're going to have 10 more. You're going to have 10 more swings between now and the election. That doesn't make any sense.
Guys, we got up to $85 in crude before we came back off. 82.50, which still seems really rich to me. The curve is indicating that there's, the curve isn't misaligned with the underlying. Any thoughts on crude? Vol's back there a little bit. It's not great, but it's better than it's been.
It's better than it's been, but it's still a kind of a crappy trade. You're trying to squeeze money out of it. I think a better trade, Vic, has been what you talked about before, which is the small caps, number one, and also something we've talked about a lot on this show, but they finally started to poke their head, is the Chinese stocks. They got little bump last week, and they got juiced up, and they came for like Baidu and Baba and a couple of other ones, and FXI, rallied, I don't know, 5%, 6%, whatever it is. Anyway, I've been trading a bunch of those from the long side, and that was a trade that actually worked last week.
Finally.
There was some rotation all over the place. Like Intel finally went up. Like all these pigs that can't buy an uptick. They bought some uptick. They came for the pigs last week. They rotated into some of these stocks that haven't had an uptick forever. And so some people got a little money back.
In a few ways, you can tie some of that back into. You can tie all that back into a higher probability of starting the rate cut cycle. I guess.
No, I like that's not it. I'm not buying that stupid rate cut thing. That rate cut thing's been priced in. If you were going to buy Chinese stocks on a U.S. rate cut, you would have done it, 9 months ago. They finally rallied because everybody realizes that on paper, they're freaking cheap compared to U.S. tech companies. That's it.
I could say the same thing back to you, Tom. If you're buying them because they're cheap, they've been cheap for the last 6 months. So anything you want to say back to me, I can say back to you, because
no, you can't.
No,
You
listen. They've been cheap not only relative to themselves, they've been cheap relative to their U.S. counterparts, and they've been cheap relative to their Hong Kong and China listings. They trade at a discount relative to where they trade in China. So you want to say you're buying them because you're cheap? They've been cheap.
No, this is all true, except that nobody wanted to sell U.S. tech stocks to buy Chinese tech stocks. Now, all of a sudden, U.S. tech stocks became a little less attractive when they bid up the Russell. So all of a sudden, they rotate. When you sell NVIDIA, what are you supposed to buy? I mean, these are like, you got to find something. That was like, I forgot who it was. I think it was David Tepper. Somebody last week basically said the same thing. What else are you going to buy? You got to buy something. It's just a rotation.
Look at you. Did I hear you just quote David Tepper?
No, I can't stand David Tepper, so I didn't quote it. I mean, I just brought up somebody else mentioned it. I would never listen to him. He's not one of my favorite people.
Do you need to hire?
What do you think about metals?
You know what? I think it's. I think you look at gold, silver sitting at 78. Vol's in. We're still at the upper level of the ranges. I want to see better tape action to either side before I start to get that interesting. Silver is a tough trade right now. Copper was interesting below 450, 440. That was an interesting place for it. Like if you were looking for a 20, 30 cent scalp, Vol's still rich in there. And it's still underperforming all the other. I mean, copper had a really tough time when silver and gold had some legs last week. So does copper catch up, or does gold and silver give some ground? I think copper probably catches up a little bit. So I wouldn't mind if copper gets back down below that 450 level, selling some puts in there. Market's rich, and it's actually tradable. So
it's tradable. It's really tradable. I think it's better. It's definitely better trading than in silver, and it's almost as good as trading as in gold. So I have exactly the position you just said. I'm leaning long copper. Pete, hey, we got it. It's late. We got to get Ilya in here. Otherwise it's going to be. He's going to be like putting his kids to bed. Who knows what he's going to be doing?
Thanks, Pete. All right, guys. Have a great night. Thanks.
See ya.
He's going to be packing up for the Poconos or whatever. You're going to be loading up the car. You're not driving the station wagon out to the Poconos, are you?
If I had a station wagon, maybe I'd consider it. But since I don't, I can't.
Have you ever owned a station wagon? That's a good question.
I have never owned a station wagon.
Oh, you have, Vic?
No, but I would. 100% I would.
I totally
would own a station.
Yeah. Mm-hmm.
Really?
Yep.
I had a Volkswagen station wagon when I was in college. It was like a yellow. They made a station wagon, but it was a weird looking car. That's the only time in my life I've ever owned a station wagon. I paid $300 for it.
Wow.
But anyway,
there's an inflation discussion somewhere buried in there, but I won't take it there.
Anyway,
Ilya, what'd you think about go ahead, Tom.
No, go ahead. Go.
What did I guess, what were your thoughts on the macroeconomic releases last week? The big one.
I thought the story was very, very interesting, and I thought it spoke to a change of thinking in the markets. The days when Powell gave us something new, and then that was on Tuesday, he came out and he was dovish, and that was a change of tone. For months, he'd been talking about, we're frustrated that inflation isn't going down as fast as we want, higher for longer, etc. This was a very clear move away from that, and a clear, like, okay, now we're thinking about, we don't want to over-tighten, we don't want to unduly hurt the labor market. He was dovish, and the market didn't like it. The first day, it was up before he spoke. He spoke. It came back down to basically unched on the S&Ps, and the dollar rose, which is weird because he was dovish. On Wednesday, the market ripped. He didn't say anything new, though. On Thursday, CPI confirmed what he said on Tuesday, dovish, and it dumped. So, and then Friday was amazing. It attempted to rally all day, and then into the close, they came for everything, by the way, including Russell. So Russell couldn't hold its move through the swing high either. Dow couldn't, S&P couldn't, NASDAQ couldn't, everything got cooked. And so what that's telling me is there's some kind of a head change that might be starting to occur in markets where, as I was saying last week, it's sort of like the dog that caught the car. It's all well and good to speculate on future rate cuts that are always a quarter away. If they're here, and at this point the market's baked them in, that's it. September is a done deal. And that's only a meeting away. So there's a meeting this month where they'll kind of make official the tone shift, and then September is go time. In between then is Jackson Hole, where they'll come out and say, our new focus henceforth for all to hear for the next year will be the cutting of rates. Hear ye. And that's it. It's done. Now the question is, well, if they're ready to go now, they found something that's intolerable enough in their vision that they need to act. And that's going to, I think, start to be a sentiment killer. Maybe a slow one, maybe an uneven one, but I think the vibe has changed.
I would agree with you that it definitely seemed to be like Thursday was a complete sea change in how risk was deployed after that point. We've only had 2 days, but I do think it was so emphatic that we start to see a completely different market in the back end of the year than we saw the first half of the year, as Tom said earlier. But I guess the question would be, is it risk off or risk rotation? I think that's the bigger question, Ilya. Is it risk off or risk rotation? And what do you think about that binary choice?
I think any earnest risk off begins with risk rotation. I don't think you can get to one without going through the other, unless there is some kind of a crazy collapse out of nowhere. But very rarely in, let's call them, efficiency-seeking markets, very rarely does something come out of nowhere. I wouldn't go so far as to say the markets are perfectly efficient, but they are certainly efficiency-seeking. And very rarely is anything going to just jump out of left field completely. So I think you probably go through a period of some rotation, which maybe you're already starting to see. I think rate cuts are probably thought as good for the Russell, and we saw that last week because of the regional banks. I mean, KRE was smoking last week. Largely, I would think, because closer rate cuts means that the risk to regionals is maybe lower, that maybe you start to look a little bit safer there. Maybe another SVB is less likely if the cuts are getting closer, etc. So maybe there's some logic there. But ultimately, I think you get into a very kind of big risk-off wave of some sort. Ultimately, we'll see when. I wouldn't be surprised if it's closer to September, October.
What does that mean for your positioning with the dollar? Can you have let me ask you this question a different way. Can you have risk off and a weak dollar in your mind?
It depends where you have the risk off and if it's a broad-based risk off thing. If stocks are selling off, the dollar can sell off at the same time. But if risky assets writ large are getting dumped, if it's like another 08, if it's another breakout of COVID type of thing, dollar's going to rally. And it's going to rally hard because everything's going to cash, and that's the cash of choice because liquidity. You don't want to cash out into something illiquid.
And then I guess my last question, Tom, unless you have any, would be your thoughts on yen and the intervention we saw last week.
I mean, I don't have any thoughts on it. I told you earlier, I thought that it was, the intervention didn't surprise me. And I think that a lot of the weak hands, that were buying yen didn't get the move they were hoping for with the intervention. So they kind of puked it out. They just took their money off the table. I think you're going to see the yen, the risk reward in the yen is you've got maybe, 1,000 ticks to the downside and 10,000 to the upside. I mean, I don't even understand how anybody could be short the yen here. It doesn't make any sense to me. I mean, from a risk reward perspective, the pot odds are massive to the upside. So Like, I don't care what the Bank of Japan does. They're as clueless. They're more clueless than our Fed. And the Bank of Japan has screwed up the Japanese economy for 30 years. I mean, why would I give a rat's ass what the Bank of Japan does? I mean, I would basically trust any organization in the world, the central bank in Russia, more than I trust the Bank of Japan. So I don't care what they do. But I'm a trader, so I think the yen is, the pot odds of the yen going higher. It's probably pretty good. That's it. I don't have any other. I mean, I'm not gonna mortgage the house and bet on the yen, but I just have a pretty nice, decent sized long position there, and I think for the first time in many years, I think I'm going to get paid for the next year or two.
Ilya, what do you think? Same question.
The yen is sitting at the bounds of the up move in dollar yen or the down move in yen futures since the beginning of the year. If you basically look at if you take the simpleton's view, as I like to do, and say that an up move is by definition a series of higher highs and higher lows, and a down move is by definition a series of lower lows and lower highs, we are at the bounds of what that series is here for the yen. So you're basically on the deciding line. If you were to say right here that you're getting in one way or another, I'd say the risk reward isn't good. Obviously, in Tom's case, he's been long, so that's a different conversation. But to get in here, to initiate in yen here, I think is not very good risk reward one way or another. I also don't think it makes any sense to be a seller of yen. None. If you're going to do anything, you're going to be buying yen. I want to be buying yen. I don't want to be buying it here. So either I want it to come back a little and maybe end up somewhere around 63 again, and then I want to be a buyer there, or I want it to break out and take out some of its recent bottoms and then give a little bit of confirmation and say, okay, yes, I'm ready, and then I'll buy it then.
Fair enough. Gentlemen, going into the week, real quick question, just long, short, or neutral, E-mini S&P?
Short.
I'm short.
Still short. I'm short from last week.
NASDAQ?
I am short. I'm short all the major indices except for, well, I shouldn't say it. I'm short the NASDAQ and the S&Ps. I'm long the Russell. So I don't have any Dow positions on. So it's pretty much, I'm skewed. So short the S&P, short NASDAQ, long Russell. I'm riding or dying with that position this week.
Ilya, what do you think about the Russell?
I haven't gotten into NASDAQ yet, but I want to be short, and I liked Friday's price action. So I'm going to be looking to see what the risk reward on some short MNQ or the Qs put verticals look like once markets come alive.
All right.
Yeah, I mean, they're relatively, most of the put verticals, because skew is not very heavy right now, so most of the put verticals are, they're cheap.
Yeah, they'll be okay.
Yeah, they're cheap.
I'll simplify the next one into just Chinese stocks instead of picking out any individual one, and I'll do it through FXI. Your opinion on FXI going into the week? Is the move over? It's time to fade it? Go neutral?
I don't have a position in FXI, but I'm short ASHR. I've had it for a while. I bought a put, very long dated put, like 200 days out in ASHR. It's basically at the bounds of its down move, so it'll either show me wrong in the next day or two and I'll get out, or it'll resume going my way because it was working and then it bounced. So now I'm basically at the decision point of this bounce was a correction and it's gonna go down again, or it's turned and I gotta limit my losses. We'll see.
I'm on the exact opposite side. I'm long FXI. I sold a bunch on Friday into the rally because, I was finally, I bought it a little early, so I was finally up like a little over $1 on it, so I sold some out. But I'm a buyer on any dip. I think you have to be long every single Chinese stock. Doesn't even matter what it is. I mean, if there's going to be rotation, the cheapest plays out there, you got to be long all the cheap plays. And, I mean, the cheap plays just work. And I think you just got to be long China. I mean, any kind of dip. I mean, the S&Ps have gone from 3,000 to 5,500, and FXI has gone from 40 to 26. I mean, that spread is at a level of, levels that we've never seen in history. I don't know. Seems to me to be a decent risk reward.
I'm on the same side.
Logic,
I'm on the
by
same
the way,
side.
is what got me into.
Yeah, that logic gets me in trouble all the time. I'm not saying that logic always works.
It didn't get me in trouble. It's the best thing in my portfolio right now. I bought EWW at 56. It's closing in on 62. Same exact logic.
Mexico's different. Mexico's very different because Mexico's kind of like it's kind of a manipulated economy. They don't, their currency doesn't fluctuate. And a little bit different. They really just mirror kind of the U.S. But
it was the same logic. An election happened that people thought changed things, but didn't actually, in my thinking. And so I thought, oh well, this is overdone, and so now it's cheap. Bye.
Yeah, elections have far less impact on global markets than people think they do. Elections just, everybody thinks that elections are going to have this, massive equity impact, and they really just don't. The markets are too highly correlated to too many other things, and people rarely bet. They impact social things. They rarely impact economic cycles. Now, the companies are too big. I mean, the concentration of power and wealth these big companies have right now, it's too big. You can't get elections don't matter in that sense.
In my mind, it's sort of sequencing that doesn't line up with markets time wise, both at the front end and the back end. So elections might have a kind of day or two of volatility kind of impact, like we saw in France, like we saw in Mexico, but ultimately markets don't care. And then they might have consequences 10 years from now, 15 years from now. But again, that's the wrong window for markets to see. So either way, markets end up in this space where elections might matter a little and then not, and then a lot later, but for markets in real time, also not. So it's kind of a weird pocket where the markets aren't on the same timeline reaction function.
Embedded in what you just said, Tom, is that there's an illusion of policy difference between candidates in major elections. But if there isn't much difference or volatility in markets, then perhaps that means you're either saying markets are a really good discounting mechanism and they're good at pricing out volatility given the discount, or that there aren't really many policy differences between candidates. There's maybe an illusion of that, and therefore it doesn't really matter to markets which candidate ends up winning. Let me ask you, I'll simplify the rest into just a dollar conversation. Dollar long or short this week, Tom?
I'm going to be short dollars from now until eternity. I'm not getting long the dollar. It'll be 10 years before I ever buy a dollar.
I'm a little bit long.
You're right, Elliot.
I'm a little bit long. The Canadian dollar has been the only one that has made absolutely no hay of this dollar weakness elsewhere, which I think speaks to something that's weak. I think that also speaks to maybe people are starting to perceive the kind of turn in the U.S. business cycle that you might surmise from the reaction to CPI, the reaction to Powell. I think a turn in the U.S. business cycle is now a real thing that's starting to happen in the market's thinking. And so I'm a little, and Canada is obviously directly exposed. So I'm a little bit short MCD, the micro version of 6C. I'm looking at the euro. It's basically right back at its high at 109, the swing high, saying, okay, well, this might be an interesting spot to get short. We'll see. There's the ECB meeting this week. They'll probably sound relatively dovish. So I'm looking for some confirmation there. Otherwise, I'm standing aside. I think that when the risk aversion comes, the dollar will absolutely bulldoze over everything, except yen. Yen's going to rally as well, but that has to happen, and the price action will it'll get to show it, but it's not showing it yet.
All right, everybody, hit the like button on your way out the door. With that, I'll hand it to you, Tom. Take us out.
Well, listen, here's another good show, boys. We had a show in Chicago this weekend, huge packed house over at the Park West. It was awesome. Right. So thanks, a big shout out to everybody that came to the Chicago event. And this week we've got next event. We're up in Toronto, first show in Canada in a couple of years. So if you're new to Tasty or in the Toronto area, you want to sign up, tastylive.com/events. It's a whole different event in Toronto than we had in Chicago, all different speakers. And looking forward to that fun July expiration week, Vic. So some, there's a few earnings kickers in there. So we're going to have some fun stuff to do this week. Plus, I think the market's going to be I think we might get a little volatility this week. Let's see.
Fingers crossed.
See you tomorrow, 7 a.m. Central.
See you tomorrow. Peace.